All right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormick, excited to be with you today. We're going to be jumping into a topic that is very near and dear to my heart, especially as we are in the midst of tax season, meeting with a lot of clients, a lot of prospects, and just see a lot of things that concern me, but also a lot of things that give me hope. And so we'll talk about the two ends of the spectrum. Before I get into that, I just want to thank you for listening. I want to let you know that it is an honor to bring this podcast to you, to share thoughts about taxes and ideas about taxes and have people actually pay attention to it. You know, we can throw stuff at a wall, but not all of it sticks. But to see that our audience continues to grow is such a privilege, and I know we are blessed in that regard. So if you are new to this channel, welcome. If you are a frequent listener, thank you. And if you get any sort of value out of this, please share it with a friend. This time of year is one of the biggest times for people to be concerned about taxes and looking for tax solutions. So you don't know how far you could be helping somebody if you just do something simple as share a podcast or a YouTube episode with them, especially when that will result in more money in their account. So again, thank you for being with us. If you're on Spotify, YouTube, Apple Podcasts, wherever, we appreciate you. If you haven't checked us out on any of those platforms, be sure to subscribe and stay tuned as we're releasing episodes every week. And we are continuing to have more guests on. And if you know of anyone who might be a good guest to have, whether they're in the tax space, the personal finance space, you name it, we would love to at least see if they're a good fit and if they can provide value for our audience. The real estate space, we do better by coming together and sharing more together. So today we're going to be talking about what I refer to as the tax trap. The habit of so many people to wait until year end to think about taxes and why that's costing them thousands and thousands of dollars. I tell you that this is a very near and dear topic to my heart as we are in the middle of tax season, and I see prospects who have large amounts of income for the year, and had they come to us, say April of last year or May of last year or even January of last year, we would have been able to stay on top of it. But now it's a lot harder to plan around taxes because the year has passed. And that's not to say that we can't do anything. We're implementing some great strategies for a lot of our new clients that will save them tens of thousands of dollars. But I know that there is more that can be done throughout the year when we're meeting regularly and considering the inflow of income and what it means from a tax perspective. So all that to say, if you are thinking about taxes in April, you're already too late, right? Tax planning is the solution. Tax preparation is not. Today, we're going to be diving into the costly mistakes business owners and real estate investors make by waiting until tax season and how you can start saving money today. Obviously, I would be remiss if I just told you all of the problems in the world, right? We don't need any more people that are telling us problems. We need solutions. We need cold, hard systems and processes that we can implement and take action. So there will be an action step for you to take at the end of this episode. We're trying to make that a regular rhythm of this podcast so that you're not just fearful and stressed out because you are waiting till April. We want to give you action steps. But we know that most entrepreneurs and real estate investors, you guys focus on making money and you're really good at it. You make a lot of money throughout the year, but you don't realize how much you're losing in taxes, right? You can make $300,000, $400,000, $500,000, $1 million, $10 million. And it's great, but if 40-50% of that is going out the door in taxes, whether it's federal tax or state tax or property tax or sales tax, capital gains tax, like if you are making all that money and half of it is going out the door to the US government, there is a problem. And so the problem is that you only start thinking about taxes when it's time to file. By then it's too late to fix most mistakes. And you guys are leaving thousands, if not tens of thousands, if not hundreds of thousands of dollars on the table. You know, we had a stat, I think it was in the Entrepreneur magazine, or maybe it was Forbes, I can't remember. One of those publications that said 93% of business owners overpay in taxes simply because they don't plan ahead. We have also seen that Americans, the American people, overpay $1 billion in taxes every year. And this is not a result of a lack of planning. It is simply because of mistakes. So there is a good chance, whether you're in that 93% of business owners who aren't planning or that stat of $1 billion in overpayments by the American people because of mistakes, there's a good chance that something is being missed and you're overpaying, you're losing money as a result. Some common mistakes we think of are not tracking deductions in the real estate space, missing depreciation benefits. Even not in the real estate space, there's some great opportunities to capitalize on depreciation, and that will become more so as we enter into what people are calling this golden age of the US economy, right? There's tax changes that are happening. Donald Trump recently announced that he has full hope and plans that his initial tax cuts in 2017 will be made permanent or at least be extended throughout his presidency, which would mean that depreciation and bonus depreciation receives an uptick. So you have these not tracking deductions, you have these not maximizing on depreciation benefits, and another big one is the self-employment taxes. We're going to be diving into those 3 today. Now imagine you are in the real estate space. You've had a great year, right? Whether you're selling properties, you're buying properties, you're wholesaling properties, you're flipping properties, earning rental income, closing deals. You are spending time celebrating the success. Maybe you took a year-end vacation because you had the highest income to date, and then you come to April and you assumed your CPA was handling your tax savings, but they're just filing paperwork. You come to your CPA in April and you say, hey, I made $200,000, $300,000. I have these 10 properties. I made $1 million. And we even celebrating. We're very excited about it. And then you give everything to the CPA and they come back to you and they say, okay, great. You made $1 million and now you owe $300,000 in taxes, right? $400,000 in taxes. These are real numbers that could happen if you're at that income level. If you're not, maybe you made $100,000 or $200,000 or $300,000. You could be looking at $40,000, $50,000, $60,000, $70,000 in taxes because you missed key deductions. Things like cost segregation weren't even discussed, and maybe the use of accounts or deferring income at this level so that you can get it off the books for this year and get it on the books for a year where you might not have that income. Obviously, if you are at this point where you're just giving your paperwork to your tax accountant in April and they come to you and they say you owe 5, 6, 7 figures of taxes, you're going to be panicking. That's a huge chunk of your profit, and you probably just spent it on that vacation at the end of the year to celebrate, right? So now you might have to go onto a payment plan and go into debt to the IRS. The reality is this is thousands of investors and entrepreneurs every year. I see it every year, and I do what I can to make known that the savings happen when you're meeting throughout the year, when you're meeting regularly with your accountant. But still, we get people coming in our door January, February, March, April saying, hey, I made this much money. Can you do my taxes? And I'm like, I wish I had better news for you. I want to be planning around taxes, but you're coming to me to prepare taxes. We did have one client who had this very problem. He had a great year, but he hadn't hired us for tax planning. Let's call him Charlie. He didn't talk to us at all until he realized that he was pushing up against the deadline, right? He's busy making money, building relationships, growing a business, and it ended up in $400,000 of income. That's a great year. No, most people don't ever make that in their lifetime. He made $400,000 in a year. However, he had very little to show for it in the form of bookkeeping, and he was on the hook for almost $80,000 of taxes. Again, he came to us in, I think it was March or maybe even April, and we're like, we can get an extension filed. We're going to have to clean up your books, and there's a good chance that there's going to be a tax bill. Yeah, funny enough, we found out that there was an $80,000 tax bill. Had he talked to us throughout the year or hired us in January to perform tax planning services, we would have been able to save him at least $40,000, probably even $50,000 very easily. Instead, he was left preparing for an IRS payment plan and lacking the confidence that he needed to succeed again the next year. Understand this, taxes are the biggest expense of your lifetime. Typically, if you're a business owner making $400,000 a year and you're not meeting with an accountant throughout the year, taxes will be the biggest expense of your lifetime. There'll be more than your mortgage interest, and this is income taxes. There'll be more than property taxes, there'll be more than utilities, there'll be more than your rent, there'll be more than your vacations, there'll be more than your education, your kids' education. Taxes, if you are not planning, will be the biggest expense of your lifetime. If you're not proactively managing taxes, you're funding the government instead of growing your wealth, right? The government has created a system for us to thrive in as entrepreneurs, as business owners. Yes, they collect a lot of money. And lately we've been seeing that they haven't been using that money to the best of their ability. They've been spending it in places that we wish it wasn't being spent. And we have been paying for that. Those of us who pay our taxes, and those of us, especially those of us who don't plan, have been overpaying our taxes. And as a result, we're funding those projects that we're now seeing are being paid for with our tax dollars, right? There's crazy headlines every day about where our money was going. People that are supposedly 120, 130 years old collecting social security checks. So our money's just going out the door. These people don't even exist. They've passed away a long time ago. Those are your tax dollars. And it's because you're not planning ahead. You're not proactively managing the situation. And I don't want to belabor this point, but I want to get it through your head. If you had planned ahead, then you would have been able to mitigate these taxes. Our client that we just said, his name is Charlie. He would have had $40,000 to $50,000 extra in his pocket had he been meeting with us throughout the year. Instead, he's trying to figure out a payment plan and get himself out of debt by making more money. Like now, making money one way is hard, but then when you have to worry about paying off debts, tax debts to the IRS, it's just not a good place to be. So here are some of the solutions that I would recommend. One, if you haven't gotten to the point yet, meet with a tax strategist quarterly, not just once a year. not just after the year, quarterly throughout the year, so that he or she can understand what's going on in your business, what properties are you buying, what income streams are you developing, how much money do you have. They can run tax projections if that's something that they do. And then they can say, hey, let's move money here. Let's buy this property. Let's put money in this account. Let's use this deduction. What are you planning to spend money on in the next 12 months? Let's accelerate some of these expenses so that we can get it on this year and get the tax deduction. This comes with quarterly tax planning meetings. This is what we do at Better Books. All of our clients, except for one that is on a tax planning engagement, is meeting with us quarterly. The one who's not is biannually, and they have their reasons for doing that. So meet with your tax strategist quarterly. 2, consider investing in real estate or other tax advantage assets and accounts to reduce taxable income. Consider real estate, right? And real estate is a unique strategy. Obviously, if you're listening to this podcast, you are very interested in real estate. You're interested in the tax advantages of real estate. We have been able to save people hundreds of thousands of dollars through the use of real estate. Now, just investing in real estate isn't going to guarantee you get the tax savings. I also have a lot of people that come to me at this time of year. They're like, yep, I bought these 3 properties, excited to save on tax. And then I find out that they and their wife are working W-2 jobs, making a lot of money. And so they're going to be capped out on the number of benefits that they can get this year. Now, that's not to say that we can't carve out some sort of benefits in future years or just plan strategically or make use of other parts of their situation. But if you're using real estate, it's still important for you to be meeting with a tax strategist quarterly. Think about it. If you were training for an Ironman, right? Something that I have experience with and enjoy, okay? When we train for an Ironman, we can't just go from running a 5K or even running a half marathon or even running a marathon and going on some training program that we create and get across the finish line, at least without much success. When I started training for an Ironman, the first thing I did was reach out to an expert, reach out to somebody who has the experience getting people to a physical capability to finish an Ironman and finish it well. And by doing that, I ended up qualifying for the World Championships in Kona, Hawaii. I didn't end up going, but I qualified. And so the point is, had I just taken what I had known from running marathons and tried to do an Ironman, I would have been lost. I would have been stressed, burnt out, all these things. And the same thing is true when it comes to your taxes. You can know that you want to invest in real estate or know that even real estate has tax benefits. But if you just do it on your own and try to buy up as many properties as possible and not meet with the expert who has experience and has saved people tens and even hundreds of thousands of dollars using the real estate, using the tax code and real estate as revealed in the tax code, if you're not meeting with them, you're going to end up burnt out, stressed, overpaying the US government, short on cash, and all these things that so many people are doing because they're not taking the action of meeting regularly and investing strategically. Okay. And then that's not to say that if you're not investing in real estate, you can't save on taxes. People can use accounts that are friendly from a tax perspective. We're happy to advise people who aren't investing in real estate yet on what they can do best from a tax perspective to save this year in taxes. And the third part is business structure, right? I said self-employment taxes is one of the highest places that people overpay. It's because they haven't had any sort of understanding or advice on what the right business structure is. And today you see a lot of information out there about S-Corps and getting an S-Corp to save on self-employment tax. It's great. We do it for a lot of our clients who that meets their needs. But some clients, especially those who are going to be scaling up quickly and looking for investors or plan to sell it for a great multiple in the future years, S-Corp is not where you want to be. If you're investing in real estate, S-Corp is not where you want to be for certain business practices. A sole proprietorship works for some people. It's not necessarily the most advantageous for the one who's making $500,000 in profit, right? So the business structure is huge. We need to make sure that we optimize the business structure, get the right business structure so that you can keep more money, pay less to the US government legally, ethically. This is all revealed in the tax code, and we're just using it, leveraging the tax code to save our clients hundreds of thousands of dollars. So what can you do? How can we take action on this today, right? I said, I don't want to just scare you and tell you that things are wrong and that there isn't hope. I just went through the 3 things that you can easily do about maximizing deductions, investing strategically, whether that's in real estate or other accounts, and structuring your business properly. That is not an exhaustive list. There are so many other things that we do on a regular basis to make sure our clients are paying the least amount possible. But for you, the listener, maybe you're a client, maybe you're not a client, but I understand that it's tax season. I understand you're probably trying to compile information and get it over, and you're probably even worried about what that tax bill is going to say. Most of you probably don't want anything to do with more than that as it relates to taxes. But I'm telling you, rather than facing a hefty tax bill, if you can take a few small steps, a few actions to better plan and be better prepared for the following year, then we want to do that. So Here's the action steps. Find a tax advisor, a specialist who you can meet with regularly. And that way you can stay on top of what's going on in your business and make moves during the year rather than at the end of the year to save on tax. That is your action step. Consider real estate, consider tax deferred investments. I think just coming up with an idea of where you want your money to go, all this extra money that you're going to be saving by meeting with a tax planner, meeting with a strategist throughout the year, think of ways that you want to deploy that capital and put it into tax advantaged accounts. So those are your action steps. Find a qualified tax advisor and then think of new ways to invest or even existing ways to invest that extra capital that's going to come in as a result of tax savings. And then the third one would be consider your business structure. Have you optimized your business structure? Have you met with a strategist to see if it's the best entity? Have you done it 5 years ago and now your business has changed? You've added certain income streams, or maybe you're thinking about selling. Are you the optimized for the situation that you want to be in a few years? If the answer to that is no, then consider the business structure and meet with a strategist to find out what the best way is. I know taxes can be stressful. I know this is a time of year where people don't want anything to do with it. They just want to get their return, find out how much they're paying and be done with it, go and make more money. But I'm telling you, if you can take these action steps, you will change your life forever. Until next time, God bless you and keep moving forward.